Okay guys, welcome back, and today we have discussed the conceptual framework. That is the topic from the SBR chapter number 3, and we have to start the conceptual framework chapter. Here, so what do we mean by the conceptual framework? The conceptual framework is basically for financial reporting is a comprehensive set of principles developed by International Accounting Standard Board, right? And the purpose is to guide the preparation and presentation of financial statement. So is to guide the preparation and presentation of financial statement, and we have discussed this in a few detail. So there's a slight difference between the conceptual framework and the international accounting framework. We'll discuss now today. We have to discuss the international accounting standard board framework, and we have already discussed the conceptual framework. And you may have to know that the conceptual framework and the international accounting standard board framework are closely related, but distinct concept and the context of the financial reporting and international reporting standards, that's IFRS. And for SBR, Strategic Business Reporting exam preparation, understanding the difference is crucial. So as they form the foundation for applying the IFRS standard and answering related questions. So we have discussed this conceptual framework in detail, and now today we will discuss the International Accounting Standard Board's framework. And that International Accounting Standard Framework is often referred to the is a framework for the preparation. Is basically the framework for the preparation and presentation of financial statement. And this was the predecessor to the current conceptual framework. So there's a slight differences, and it's a big issue. Now we have to discuss this in a bit detail, that what is the purpose, what is the scope and the status, and some their limitation. Okay, first you have to understand that this International Accounting Standard Board framework set the foundation. Set the foundation for preparing financial statement, and this will be under International financial reporting standard IFRS. Now this International Accounting Standard Board framework provides rules, convention and definitions, and these are for the purpose is to ensure the consistency and reliability. Okay, so the main purpose is consistency and reliability. Now what are the key purposes? Let me write it here, because you have to write these for in your exam. The key purposes of the International Accounting Standard Board framework. The first one is guide standard development. What does it mean? It means that ensure that the IFRS standards are built on a consistent conceptual framework, right? The second thing is, the purpose is to fill gaps and standard. This means that this International Accounting Standard Board framework offers guidance when there is no specific IFRS standard exists for a situation. So when there is no specific standards that tackle the situation, and that is this framework is helpful, right? The third thing you have to know, that this improve existing standard, which means that this framework support the refinement and updating the IFRS standard. So when there is flaw, then this framework help sort that flaw, right? The fourth thing you have to remember, that is the key purpose of the International Accounting Standard Board framework, and that is ensures useful information. In simple terms, you say that execute a guarantee that the financial statement provide relevant and reliable information for the user. And this is the main concern that you have to understand, that we are focusing here the relevancy and reliability of the information we are providing to the user. And the last will be that it also helps to prevent creative accounting. which means that it reduces the manipulation, of the data by promoting you may say like transparency and consistency and reporting. So these are the 5 key purposes of the International Accounting Standard Board framework. The first one we have discussed is the guidance they provide to standard development. And then second, we have discussed that it's fill the gaps and the standard, and then we discussed that improve the existing standards and ensure useful information, and it provides some protective layers from the creative accounting. Now let's move on. We have to discuss another concept, and that is the general purpose financial reporting. So the purpose is very simple. The general purpose financial report is to provide a useful information. And these information will be for the primary users. That might be your existing and potential investors, creditors, and lenders. So the purpose is to provide the useful information to the primary user, and this information we are providing to the primary user, this will help them to decide whether to provide their resources to the entity. So when they have the information, when these investor, creditor, and lenders have useful information about the entity, then that the user will be in a better position to provide the resources to the entity, whether they are willing to provide the resources to the entity or not. And when someone gives you something, then definitely there may be some motto. The user will also need the information, and this information is why they are interested in this information, because they are providing resources. So what user need to know? What user need to know? The first thing is their expected return. Definitely, when they're providing resources to your entity, then they will expect some return, and user assess the amount, timing, and uncertainty of the net cash inflow. The second thing they want to know is the management stewardship. By this, we mean that the user wants to know that how will the management uses the entity economic resources. When they are providing resources, then definitely they have the right to know that how you will use those resources, whether you are using for the betterment of the user, or you may use it for your own benefit, right? So the key information provided will be the asset and liability. The asset and liabilities. So the entity economic resources, by asset we mean the entity economic resources, and by liability it means that the claim against it. The second thing that you provide is changes and resources. Which means that how these asset and liability changes over time. And the third thing which needs to be provided is the management efficiency. That how effectively management use resources and meet responsibility. So these are the key information they provided to the user. Now the key point here is let's move on to another topic, and that is the key point, and that, let me write it, is the going concern assumption. The going concern assumption. First, you have to understand that what we mean by the going concern assumption, because it's the foundation for preparing the financial statement. So what it means, the first thing you have to understand that going concern assumption means they assume that the entity will continue operating for the foreseeable future. The second thing is there is no intention or need to liquidate or stop trading. And the third thing, that the financial statement are prepared on the basis unless stated otherwise in the note. So the financial statement are prepared on the basis unless stated otherwise in the notes. So by going concern, which is the foundation for preparing the financial statement, means that assuming that the entity will continue operating for the foreseeable future and there is no intention, there is no need to liquidate or stop trading, and the financial statement are prepared on this basis, unless stated otherwise. So it means you have to prepare the financial statement on this basis that the business will operate for foreseeable future and there is no intention, no need to liquidate your business or stop trading. So if the going concern is uncertain, a typical reconstruction may be needed to stabilize the entity. So what you have to understand, let me write a memory test for you because it's a very basic concept and you have to be aware of it. The going concern is equal to business keeps running smoothly without plan to close or sell off the asset. If this in doubt, then check the notes and consider reconstruction, right? So this is the key concept you have to understand. Now let's move on. We have another concept, and that is the key elements of the financial statement, and then we will break it down in detail. You understand it. Okay. Now let's start from the very beginning. The key element of we understand the concept of asset. That's what we mean by asset. Now we have to understand the asset from the accounting framework concept, the IFRS conceptual framework perspective. For clarity, I will just break it down the concept where you will have seen the right. You have also seen the term economic benefits. But before we dig it and detail, let me write the definition of the asset. Maybe you have forgotten. So a resource you control that can bring future economic benefits due to fast event. So that will be your asset. That resource will be your asset which you can control and that can bring economic benefits due to the fast event which happened in the past. So here we have three things. The first one is right. The second is economic benefits and control. By right we mean that the asset is fundamentally a right. It's fundamentally a right which may or may not involve another obligation, which may or may not involve another party obligation. This means, for example, you have a right to receive cash, and that is account receivable involves another party obligation because the another party has obligation to pay the amount, and this is you have the right to receive the cash, and the another party has obligation. Another party has obligation. So here I have written here that which may or may not involve another party obligation. So account receivable is the right where there is the involvement of another party obligation. On the other hand, if we see that you have right to use the property, plant, equipment or sell inventory, and that does not involve the another party obligation. So for that, I will write here that the use of property, plant, equipment or the sale of inventory does not involve the another party obligation, right? So we have to understand that the first thing is right, and right is fundamentally asset is usually fundamentally a right, and that we have to understand that which may or may not involve another party obligation, and we have discussed that account receivable which involves another party obligation, and the right to use the property, plant, equipment or the sale inventory does not. So okay, one point you have to understand that not all right to asset that must have the potential to produce economic benefits and be controlled by the entity. For example, your right to use the public resources like a public right of way or non-exclusive know-how they control and thus are not asset. Now let's move on to another concept. Here we have the economic benefit. By economic benefits, it means that these are the potential inflow. These are the potential inflow of cash, or you may say that avoidance of cash outflow. So, or you may say like the favorable exchanges that an asset can generate, that will be your economic benefits. So economic benefits are the potential inflow of cash, or avoidance of cash outflow, or favorable exchanges that an asset can generate. For example, let's say inventory can be sold for cash, or owning equipment can avoid rental costs. So these are the two things. When you are selling the inventory, you are getting the cash, this is a potential inflow. Okay, are you owning the equipment, and that equipment help you to avoid the rental cost? This means that avoidance of the cash outflow. While acquiring, right often involve payments, purchasing inventory. Not all payment result in asset. You have to make sure that not all payment result in assets. Some are expensive. For example, your maintenance cost. So conversely, asset can be acquired without payment, such as through government grant. Even if the likelihood of economic benefit is low, a right can still qualify as an asset, and we'll discuss this later. That why we are saying that we can say that this is what right can still qualify as an asset. This is we were talking about the recognition measurement in financial statement. So there you understand this in more detail. Now the third thing is control. By control, we means that the entity can direct the use of the resources. Which means they decide how to use the property, plant, equipment and obtain its benefit while restricting other from doing so. So this is actually means that you have the right to the asset, and you are getting the economic benefit from that asset, and you have control of that asset. That means that is your asset, and each one. And controlling means that you have the ability to track the use and restricting other from using that asset. So this ensures the economic benefit flow to the entity and not to the other. Okay, we have understand this concept in a bit detail. What is asset, and what are the key terms which need the clarity, because you have to apply these concept over the scenario where you may be asked that whether the agreement due asset, whether the agreement due liability, and if you don't know the concept behind the rights, economic benefits, control, then you'll not be able to take such a type of question. Okay, let's move on. We have discussed this in a bit detail. That the key element which is R, C, and E. By R we means right. Let me write it here, right. By C we mean control, and by E we mean economic benefits. So you have a right to receive the cash or use the equipment, and not all right for asset. We have discussed this, and they must also meet the other criteria. And by control, we have discussed that you can direct resources, the resources used, and keep at benefits, or decide how to use the machine and stop other from using it. By economic benefit, we have discussed that resources can generate cash inflow, save cash outflow, or allow favorable exchanges like selling inventory, avoiding rent by owning properties. So the key notes you have to understand here, that rights like public taxes, public roads are not asset because you don't have to control them. Economic benefits can have a low likelihood but still qualify, though this affect measurement, and we'll discuss this later when we're talking about the recognition and the measurement. And by asset, as it can be come from the payment, by buying inventory or without payments, so government grants. So these are the key concepts you have to understand. Now let's move on to another concept, that is liability. If you have not clear with this, then you have to watch it again and again, because this concept is very crucial for your exam. Now liability is basically, I'm writing this in you may say in a casual way for your understanding. And liability, I would say in a casual way, that is a duty that you cannot avoid to transfer a resource due to past events. This means that there's something happened in the past, and they generate a duty on you, and that is unavoidable for you to transfer the resources. That means that you have obligation to transfer those economic resources, and this happened because of the past event. So I have you mentioned three words. The first one is obligation. The second one I mentioned is transfer of economic resources, and the third one is P, which means past event. So by obligation, we means that a duty you cannot practically escape, owed to someone, in a person, entity, or society. So it can be legal, like a contract. It can be constructive, like public promises to tax damages that create your constructive obligation, and then you have to to perform that duty. By transfer of economic resources, means that you may have to give up something valuable. For example, package, provide goods, and no need for private transfer, just a potential one, and that will qualify liability. And the third one is past event, and we have discussed that obligation arises because you have already received benefits or taken action, like you borrow money or cost damages leading a future transfer. So the thing you have to keep in your mind, that no need to know whose obligation is who. A low chance of transfer doesn't disqualify liability, but this effect the recognition and the measurement, and we will discuss this later, that you have to recognize the liability or not in your financial statement. There may be some cases that you have liability, but that will not be recognized in your financial statement because there's some reason, and we'll discuss this later. Okay, so we have discussed the two concepts in very detail. We have discussed the asset, we have discussed the liability, and here we have discussed the key element of each. That asset, you may have R, C, and E formula, right, control, economic benefit, and then liability you have OTP. By this we mean obligation, transfer, and past event. So now we have to discuss the asset and the liability definition from the formal perspective that you have usually write in your exam. Previously we have discussed the casual way for your understanding, that you have to understand a better way. Now I will write here the definition, the proper definition that you will have to quote in your exam. An asset is a present economic resource controlled by an entity due to fast events with the potential to produce economic benefits. Okay, by economic benefits we means that these can be cash inflow, avoid outflow, or favorable exchanges. The benefit do not need to be certain or likely. Even a low probability qualifies. However, when there is likelihood, when this likelihood is low, and this will affect the recognition. This will affect the recognition and measurement. By this we means that whether the asset is recorded in the financial statement, it's about recording in the financial statement, recognition, and measurement, how its value is determined, reflecting the asset and valuation. And for recognition criteria, let me elaborate here. A recognition criteria. That an asset is recognized. Asset is recognized only if one, number first thing, when it's meet the definition, and the definition was right, control, and economic benefits. That is RCE. And the second thing is, which I have told you, that will affect the recognition. When this definition is met, it means that qualify the resources for the asset. But when it means that it provides useful financial information, means the information is relevant and faithfully presented, then you have to recognize that asset. If the asset meet if the resources meet the criteria of the RCE, then definitely it will be qualified for asset. And if it not provide useful information, then it will not be recognized in the financial statement. So for recognition of the asset, they should meet two things. The first one is the definition, that is the right, control, and economic benefit. And the second thing, that it provide the financial information, and that financial information should be useful for the user. And by useful financial information, it means that should be relevant and that should be faithfully presented. Clear? So this is all about the asset. So the key point here is that significant uncertainty about asset existence or measurement may prevent recognition, as it might not be relevant or faithfully presented, but it qualified for the asset. So you have to understand that. Now let's talk about the liability, that how you will formally quote it in your exam. Let me write here liability. So liability is a present obligation, to transfer an economic resources due to fast events where the entity has no practical ability to avoid the obligation. Clear? So here I have mentioned three things against, and that is your obligation. Another thing I have mentioned here is the transfer of economics resources, and the third thing is the fast event. Okay, the obligation which we have discussed earlier, that a duty owed to another entity or another party, being a person, entity, or society. So it can be legal, or it may be constructive. By legal, we means we have a contract to pay. Let's say you have a contract to pay to the supplier, and by constructive, we means that a public promise to replace defective goods. So that will create a constructive obligation. And the terms by transfer economic resources, we means that obligation was giving up resources like cash, goods, like asset. The transfer doesn't doesn't need to be expected or probable, that's possible. But if there is likelihood of low, there's low likelihood, then that will affect your recognition and measurement. So whether the liability is recorded in financial statement and how the value discounted for uncertainty. And by fast event, we mean that the transaction or the event happened in the past. But here we have used the terms that is, you might say like appraise, that no practical ability. So the praise no practical ability to avoid means that required judgment, assess that the entity is truly bound. Clear? So the key point here is that there's significant uncertainty about the liability existence, mean as there really an obligation or measurement. So when the measurement is unclear amount, so recognition may not be appropriate, but it may be qualified for the liability. You have clear with this concept, the asset and liability. But let me explain. There's some similarity between asset and liability. Asset and liability, and there is potential, non and not probable. Potential and not probable. This means that neither asset or liability required economic benefit or resources transferred to be likely, but only possible. That will qualify, because low likelihood affect the recognition and measurement and not the definition of the asset and liability. Clear? The second thing is recognition hurdles. You know that both must put added here. Recognition hurdles. Both must provide relevant information. Both must provide relevant information to be recognized in the statement of financial position. By relevant information means that information is useful to the user, and these information should be faithfully represented. By faithful representation, we means that the information are accurate and reliable. So significant uncertainty and existence and measurement can block recognition. And the third thing is judgment. This means that determining the control for the asset or no practical ability to avoid for the liability requires professional judgment. And these are the key similarity between asset and liability. I hope you have understand that what is asset, that is RCE formula, right control and economic benefits. When there's low chances, the asset is still good. Check for the recognition when they're providing relevant information, useful information, and then they are accurately represented, then okay, you have to write it. The second thing is liability, OTP, we mean that obligation, transfer, and fast event. And recognition rules, we have that recognition rule is simple, that must be relevant and faithfully represented. So when there's uncertainty, no recognition, right? Now let's move on. We have to discuss a question, and that will be the end of this session. Let me check it here, the question. So here we have a question. Wait a minute, yes. And this question is asking about discuss. This is a discussion question, whether the contract with the O creates an asset or liability for the Sporting United with a reference to the conceptual framework. Yeah, this is the question. You have to discuss whether the contract, whether this contract of this company with this one create asset or a liability. And for that reason, you have this is from the ACCA study material. So I have just taken this question from here, and here you have to how to approach this question. The first thing is change the definition from the conceptual framework, and we have discussed this in a detail: asset, right, economic benefits, control, liability, obligation, transfer of economic resources, and fast event. Before we just read this scenario, you have to understand. You have to be clear. Then when there's a question whether the contractor create asset or liability, then there you have to first you have to write the definition of the asset. The asset, you have some element that is right, economic benefit, control. You have to fully grip over here. If you don't have grip, if you have just state the thing like write the definition and then you say the right mean like this and economic benefit mean like this, then this will give you let's say 6. This question, let's say the question can be 6 marks, and this one you will get 2 marks. But if you have understand, then application will be easy for you when you apply this concept over here, right? So and then after that, you have applied each aspect board definition and come to the scenario. You have does the signing and the fee create an asset, does promissory create liability, and then you will have a conclusion. You will conclude whether it create asset and whether it create liability, and if asset, then why, and what the liability, then how. So these things you have to understand, right? Let's start from here. This is the O has played football for sporting unit for a number of years, fine. Initially in the club academy teams and then in the youth squad. This is the introduction about this. He has just been signed to the senior squad. Now this is the sign is new contract and Fed assigning on bonus of this amount. So whether this amount create asset or not. The second thing is the contract is 3 years, it's a 3-year contract, and Sporting has salary, and then this Sporting United will also pay salary for a month, and the salary will review up to 1 year, right? So here we have two things. The first one is the $100 amount that the O is actually getting, or they are paid on bonus on signing, they're getting the bonus of this amount. And the second is for the Sporting company, they will have also pay $40,000 per month. Now you have to first write the definition. Then what is the definition? Let me scroll it down. You will see here. As it is defined as a present obligation, resources control, introduces a past event. This is the definition. Economic resource as a right that has the potential to produce economic benefit. This is the definition of asset. Now let's see here. In order to determine that whether this O is an asset for this company or not, it must first determine whether the club has the right overhead. So if the club has the right over this person and there is a control and economic benefit, it means that when they are right, they have control and they are also getting the benefits. That means this is the asset for the sporting unit, and they will recognize $100,000 as an asset. Alright, maybe the right to receive cash, goods and services. In this case, I have to correspond to the right to receive claim. Let me write it here. You will do it by yourself. Okay, just take a screenshot from here. Okay, and I will explain in detail, and then you will have to read this, and after that you will understand what actually I'm trying to explain. Hope you have taken the screenshot. Let me move on. Here we have, this is the liability portion. You have also take screenshot of this one. Okay, I hope you did it. Now let's move on to the scenario, and here I will explain in simple words. You see here, the first question is, you have just stated the asset and the liability definition, right? Now the question is that whether you have to discuss that whether the contract with O create asset or liability of S sporting units. So the first thing is, does the signing on a fee of $100,000 create an asset? So you have studied that whether it create right for sporting units or not. So sporting unit has a contractual right to O playing services for 3 years. So this means there is a right. The second thing is control. Whether the Sporting United has control over him or not. So the contract ensures Sporting Unit direct the O use, mean playing in the matches and prevent other club from using him. So this means that they have control over him because it's a contract for 3 years, and these 3 years the O will play part the Sporting United, and this means that Sporting United direct the O use, or no, I don't know how to pronounce the word, playing in the matches. And the third thing is economic benefit. So the O services, which is the player name, services can generate ticket sales. There may be some shirt sales. There may be some sponsorship incomes, even if uncertain due to injury or other things. They still qualify for an asset. So the conclusion is, you will have to write that signing on a P create an asset is all services meet RCE, means right, control, and economic criteria. However, recognition depends on whether the benefits are relevant and reliably measured. So the first thing is the $100,000 should be qualified for an asset. Now the other portion is that whether it's create liability of this amount of $40,000 per month for the sporting unit, Sporting United. So we have studied that O obligation and then transfer dynamic resources, OTP, and the first event. So obligation is the contract create a duty to pay to the relevant player $40,000 per month with no practical ability to provide one services upwards. So when that providing the services, definitely the Sporting United will have to pay them. So this is the obligation. The contract create obligation for the Sporting United. The second thing is transfer of economic resources. So the payment of salary is transfer of cash. This means that you have to transfer the cash. But here is the thing. But the obligation only arises when that professional provides services each month. So once the month finish and the services provided by the O to the Sporting United, then it create the liability for the Sporting United to for this amount. But at the start, initially, he has not provided any services, so means there is no transfer of economic resources at the initial phase. And past event, no obligation exists at the contract start. It's working that it hasn't yet received the all services. So after each one of the services, a past event service is provided. There will be a past event, mean the service is provided, so that will create liability, that will create the transfer of economic resources. So here in the case, in conclusion, I will say that when you multiply the 3 years with the 40,000 per month, and I think that will be like 144 million amount, and this amount is not a liability at the contract start, is no services have been provided. So once service is provided, the liability of 40,000 liability arises each month when that particular player plays for the Sport United. So in the final conclusion, you will say that signing on a peak created asset because given the rights and control and potential economic benefits, while the salary create liability only for services already provided. So when they have provided these services, they definitely the 40,000 per month will be accumulated with the liability. But if they have not provided in services at the start, so that means that 4,000 per month liability will not arise. So this is actually the thing you have to understand and you have to write in the way you can say. Thank you for watching.